In this video, we're going to conclude our discussions about growth. What happens if a company has too little growth? That is, their profits exceed the need of cash. They make enough money, more money actually, than what they need to increase the asset base because of increasing sales. Doesn't sound like a big problem, but we do need to understand how we want to manage that, right? So let's look at Hasbro, see what's happened here. Again, if you look at their sustained growth, again, sustained growth has been increasing over time, but relative to its actual growth up until 2015, almost, in that year was almost 4-to-1, the difference, relationship between sustainable growth and growth. So they've had a cash, excess cash for many years, and now finally it's actually switched. In 2016, they now have a sustainable growth rate that's higher than the actual growth rate. So what does this mean for Hasbro? How did they fix this? Well, they increased some profitability. Again, if you go back and look at that graph, you can look at that. They increased their retention rate. They also repurchased some shares. We're going to talk about this a little bit later on in this video, how that might help. They have an increase in asset efficiency, but their leverage ratio was fairly constant. So they made some changes over this time frame that brought them closer to balance. Now it's flip-flop. They have the other side of imbalance now. So previously, they had cash surpluses. In this last year, they now have a cash deficit. So again, what do they need to do to make this work, if you will? So we ask a very simple question. Is this situation temporary? If it is temporary, then we just build up some cash because we'll need it later. If it's not temporary, we need to ask, is this an industry-wide thing or is it just something within our company? If it's just within our company, then there's a few options that are available. If it's also within the industry, there are some things that we may think about doing that are actually very similar, right? So again, if your answer is no, it's not temporary, we still need to manage this somehow. The first thing to do is just ignore the problem, right? Accumulate cash. The challenge with accumulating cash is it attracts corporate raiders. Corporate raiders believe that companies are worth more broken apart than they are together. And if you have extra cash, that helps them pay for your company, right? Is a corporate raid bad news for shareholders? It really depends on the situation, right? Sometimes, if we have bad managers, then a corporate raid is good for shareholders because in the end, they will get premiums. They will get paid for the company that they have, rather than have it run by bad management themselves. We could just pay the money to shareholders, increase dividends, or we could repurchase shares, right? Now, the temptation of management, though, is to take this money and invest it in assets. But again, if you think about it, we say we don't need more assets, right? We just know we're out of balance with the growth rate, right? So we don't need more assets. So what management might be trying to do is what we frequently refer to as increase management's empire, right? Just make the company bigger. We could buy growth. We can buy other companies, maybe ones that need cash because they're growing rapidly, right? So history tells us this is a little expensive. In the end, it might be better to return the money to shareholders than to go out and try to buy more businesses. So again, in the end, what does this mean, right? Management's focus, management's strategy changes depending on the imbalance. If the growth rate is greater than sustainable growth, then we have to focus on getting cash for expansion. But if it's the other way around, our focus is going to be on productively spending the cash, right? And we want to try to balance strategy, growth, and financial policy to keep this difference as manageable as possible. Again, to really understand growth management challenges, we have to have the pro forma analysis to help us see how this works. So let's think about the new equity financing, right? Because we've assumed up till now that companies don't want to finance, or they don't want to issue stock. So is that true, right? Has history shown us that management does not want to finance with equity? So if you look graphically, right, these are dollars and billions of net new equity issues. And you can see that with the exception of the early 80s and a little bit of the early 90s, there is negative net equity issues. So companies are either not issuing new shares, which a lot of companies still are issuing stock, but the overall abundance of things going on with equity is that companies are buying back stock rather than issuing new stock. So much of the trend, again, has been for this repurchase, right, is that, repurchasing helps us manage earnings per share, right? It keeps that number in a place where we would like it to be. And I think more importantly, it's more about flexibility. It's a lot easier to repurchase shares than it is to increase dividends. Because once you increase dividends, there's expectation that those dividends are going to stay high. And again, if you kind of look at new stock issues, you'll also see that over time, it seems like new stock issues are growing. These are gross public issues, but IPOs seem to be a rather small component. So in general, right, what do we get from this previous graph? Says that even though new equity issues are negative, corporations still do issue stock. And they say in general, a typical public company raises new stock about once every 20 years. IPOs, though, are a relatively small part of that, right? So in 2000, when we had this huge spike in new equity being issued, IPOs contributed only about 5% of that total. Now, I'm kind of aware of the things that go on, look crazy with percentages, but you do have to understand just a small portion is this new stock issuance. So why don't more companies issue stock, or why don't they do it more frequently, right? First of all, we get other sources give us a lot of cash, right? Second, equity is just very expensive to issue, right? So sometimes it's 5 to 10% of the amount raised, and smaller companies that even increases, right? There's also some fear of diluting earnings per share in the short run. Now, if you're a knowledgeable investor, right, this doesn't bother you all that much, right? There's more shares, so that means the profits are divided by fewer into smaller pieces, but most of the time you're buying those shares. So your total earnings that you're entitled to probably doesn't change that much. Now, there's also some concern that the stock is undervalued in the market, right? So if companies are issuing stock, the idea here is that we think the stock is at a high point, and as managers, and that we think it's going to go down. So that's why they don't want to issue stock. As investors, we see that and it concerns us. They're kind of sending us maybe a subliminal message, right? That, hey, they're selling stock, they're issuing it. That must mean they think the stock price is going to fall. So we'll maybe talk about this in some later videos on how companies finance and the things they do to go through financing. Look forward to seeing you in the next video.